Hey everybody, it's Mr. Wagstaff. Cool stuff to talk about today. So today in Economic and Personal Finance, we're going to be talking about establishing financial goals and the things you need to do to achieve those goals. Let's go ahead and get started. So in today's lesson, we're going to be talking exclusively about financial goals, you setting financial goals, and the things you need to do to make sure you achieve those financial goals. Now, financial goals are something that really come out after you have a budget, you have a spending plan, you have a pretty good idea of what your income is and what your expenses are. So financial goals in its entirety really means that you are planning for something in the future. So it can be anything. You put a few examples here, like if you want to go to a bachelorette Cancun trip, and I have random years here. Some of these are actually in the past. I just grabbed examples here. But you want to adopt a pet and pay for those fees. You have to save up for that. An emergency fund, meaning what happens if you're an independent contractor or you lose your job or something like that, and there's time that you don't have consistent income. Having money set aside that you can live off of for an extended period of time while you're looking for a new job or a new source of income. That is very much a very important part of your financial plan, especially if you're susceptible to that and you work on commissions and your income is not consistent. The idea of getting a new apartment or a down payment for a house or wanting to get a new car in a couple years. All of these are why it's important to have financial goals and turning around and creating a financial plan to be able to save and set up money and set aside these things for the future. So there is commonly a rule used in finance. It's called the 50-30-20 rule. And I'll be honest, when you are young and you're not making a ton of money, this is hard to set up. But if you could find a way to make sure you're following this ratio from the beginning, it is wildly beneficial and you'll see the payoff a lot quicker in life. It's called the 50-30-20 rule. That 50% of all the money that you bring in goes to needs, meaning rent, mortgage, utilities, groceries, transportation, insurance premiums. There's this pro tip here at the bottom that you're supposed to, your rent, your mortgage, and utilities are supposed to be under 25 to 30% of your income. That in modern day is very difficult to do. I'm very aware of that. These are in a perfect world scenario. So if you use 50% of your income for all the needs in your life, then you can spend 30% of your income on wants. This is like dining out, entertainment, travel, the stuff that you don't need day-to-day basis to survive. Those are your wants. Step one of creating a financial plan, financial goals here for your long-term investments is to decide what your needs and your wants are. This is 80% of your money. Being able to divide that up, what is a need and what is a want. And a lot of it's your needs are needs. You have to pay your utilities bill. You have to be honest, you have to pay your phone bill. You have to pay rent. You have to pay your mortgage. Those are needs. Then it kind of gets cut out of the wants. You have to be very honest with yourself about your needs and then your wants, because 20% of your income every month needs to get set aside for financial goals. Basically, it needs to go into savings for something that you're planning to spend it on in the future. If you spend 100% of your income here on your needs and your wants, and there is no savings, no setting anything aside for your financial goals, it can be catastrophic for you financially. This doesn't mean that you just lose everything and start back over at zero. That would be easy, because then you can just start over fresh at any point. You can go into debt. Debt, as we'll start talking about in the next couple units, or the next couple lessons, and some next unit we talk about credit. Getting out of debt is very difficult. Very difficult. Much easier to get into debt than get out of it. So 20% of your income needs to be set aside for financial goals. So the question here is, what is the first step in establishing financial goals? And that is absolutely, hands down, you have to identify your needs and your wants. You gotta set that up because that is 80% of your money. Then you can focus on that last 20%, their financial goals for planning for the future. I am very aware when you are young and you are starting out how difficult that is. And sometimes it's going to be straight up impossible. However, by not setting it up that way, it's harder to get out of that cycle of living paycheck to paycheck. So as soon as humanly possible that you can set aside 20% for your financial goals, it will drastically improve your life, even if you have to make sacrifices for it. So, talking about financial goals, let's go through these steps here. All right, deciding what your needs and your wants are. So here's other things you have to do for your financial goals in order for them to be effective. Whatever your financial goals may be, whether that's saving for a new car, whether that's saving for retirement, whatever your financial goals are. Here is across the board what you have to do to make those financial goals a reality. Step one, choose a primary bank. That seems simple enough. And it very easily could be a very simple decision. You need a bank in which you do all your transactions with. People don't keep money in a big mayonnaise jar buried in their backyard. You need a bank in order to use their services. So banks have a bunch of different options. All banks are going to have a savings account. All banks are going to have checking accounts. But there's different types of loans they can give out. There's different interest rates, pro and con, that they can offer. So when you're choosing a bank, you have to take all that into account. But one of the most important aspects when choosing a primary bank is it needs to be convenient. That doesn't necessarily mean it has to be the bank closest to your house. But it probably needs to be a bank that is in your town, a bank you can go to, a bank that you can talk to somebody in person at and meet with them. You also want them to be able to offer you the stuff that you need, like being able to do everything online. If that's important to you, and for most people it is in the modern world, you want to make sure that your bank has convenient ways of doing stuff. I have a bank that within the last couple years added something in that I did not know. It was the most awesome thing ever. The ability to, if somebody writes me a check, I can take a picture of it and deposit it into my account. And I don't have to actually go to the bank. That's wildly awesome. It's the little things like that help you financially move more fluid through life. So having a bank that's convenient doesn't necessarily mean just in proximity, but that their offerings are effective and useful to you. So one of the first things that you're going to need to create is a high yield savings account. Pretty much a savings account. Most savings accounts have a higher yield than checking accounts. This means there's an interest rate on the savings account. You're like, oh, here we go with interest. No. When you're putting money in, interest rate is great because you get the interest rate. Because interest is thank you money. You put your money in the bank, well, that bank really appreciates you putting your money in there, so they are giving you the interest. So they're paying you interest on it, and the more money you put in, the higher the interest that you receive on top of your existing money that's already in there. This is fantastic. Now, savings accounts typically have higher interest rates, which is good for you, than checking accounts because you don't mess with the savings account that much. You put money in, sure you can take it out, but you don't have like a debit card that's connected to a savings account. So because the money stays in there longer, you usually get a higher higher interest rate on savings accounts. That's typical. So the first thing you want to do is once you pick your bank is open a savings account, a high yield, the thing that gives you the best interest rate they have there. This is where that 20% of your budget every month, this is going into that account to start preparing for your financial goals. So the question is, why should individuals make sure they have a convenient access to services? Why should they consider that when choosing a primary bank? Why is it important to have these services and for it to be convenient when choosing a primary bank? So pause me, answer that completely. We're moving on. All right, so as you're choosing a primary bank, this is something that you might not be aware of. So you can go like BB&T, Bank of America. These are all effective banks. There is a type of bank called a credit union that is a little different from those other banks. And there are some benefits to credit unions. Doesn't necessarily meet everybody's needs, but credit unions usually can offer some unique things that the other banks can't. So the biggest reason that credit unions can offer more things and unique services than the bigger banks is they are a non-profit. So the way that works is all the members of the credit union, the people that are members of the bank, put their money in, then the bank does their bank stuff, they give loans out and all that. There is no guy at the top that is making billions of dollars and then turning around trying to create more branches or going and investing in a car company over here. All the money that the credit unions make in profit go right back into the credit unions and benefit the people that are in it. Now, credit unions can be somewhat specific. Like in North Carolina, State Employees Credit Union, you have to be either a state employee to join it or be a family member of somebody that's a state employee. There's also military credit unions. And so while there's things that usually you have to be a part of in order to join a credit union, it's usually like, hey, is your great uncle ever been in the Air Force? Well, welcome. They're usually not super hard to join, but they do like to have some type of criteria associated with it in order to join a credit union. But credit unions a lot of times can offer unique and lower interest options for things because they are nonprofit. Doesn't mean it works for everybody, but credit unions can be effective for some people because they're nonprofits. Another thing you need to do to help reach your financial goals is meet with a financial advisor. Now, banks sometimes offer this, and even if there's a fee associated with it, sometimes it's a discounted fee through the bank. Financial advisors are very important. So financial advisors are going to help you understand where you need to put your money that you're saving. Financial planners, this is their job. The reason it's so important to meet with a financial planner when it comes to retirement or these long-term stuff is because you've never done this before. Nobody has. When you're planning for yourself, you've never planned for your long-term. Financial advisors, they look at everybody's long-term plans and know how it's supposed to work over time. So financial advisors are very good at helping people see the big picture when we're looking at the now. Here's a great examples of the stuff they do is savings advice, retirement planning, mortgage guidance, insurance guidance, which we're going to talk about insurance here in a minute, assistance with taxes. So, you're saving all this money. Well, how much that's going to be hit with taxes if I take it out here or there. So financial planners are very, very helpful in helping you understand where you need to be putting your money in order to reach whatever financial goals that you have. So the question here is, why would working with a financial advisor be especially beneficial for planning for retirement and other long-term goals? So pause me, answer that completely. We're moving on. All right, so let's start talking about two other very important aspects of your financial goals. The first one is investment accounts. So we've talked about having, primary bank, assuming you would automatically create a checking account, and you have a high yield savings account. Hooray. Your financial advisor might encourage you, especially if you're saving for retirement, to create an investment account. An investment account is like a 401k if you don't already have one from your employer, Roth IRA if you're independently employed, taxable brokerage like stuff to invest in stocks and bonds. So investment accounts are stuff you usually put money in and leave them and don't touch them for most of your life. And they sit there because we talked about, remember the high yield savings accounts, the reason they got a higher interest rates and you made a little bit of extra money off of those is because you weren't messing with them as much. Same thing in investments accounts. You put the money in and keep adding to it, but you don't touch it. Not only, obviously, you keep adding money in every month, the amount of money is going to grow, but it starts growing exponentially because it is a long-term investment, and because you're not touching it, the interest rates get very high. But that can fluctuate sometimes, but your financial advisor can help you understand how to put that money in investment accounts if that's a better solution for you than high yield savings accounts. There's another thing with your financial goals is, and this goes a lot back to your banks, but also when you get your utilities bill, you get your phone bill, you get your electric bill, to be able to book all of that stuff and pay those bills electronically with online payment services really makes life easier for a variety of reasons. Number one, you don't have to write checks and mail it off. It's almost instantaneous, so you can keep your balance here in your checking account. So something you don't have to worry about anymore, but if you talk to your parents, and most likely probably it's more if you talk to your grandparents about this, they'll tell you about something that was really important called balancing your checkbook. And you had to do that all the time to make sure as you're writing checks that you had to like fill out another form to make sure that you could manually keep track of how much money was in your checking account. That was a huge part of financial literacy 50 years ago, 30 years ago, 30 years ago, we'll say. It's not even part of this curriculum because, hey, now everything is electronic, it's instantaneous. So having all your bills be able to be paid virtually online using an app or something like that really does help you stay more consistent and fluid and know exactly how much money is in your account at all times. So you don't have to balance a checkbook anymore. It kind of does it automatically for you. You just check your account online, something that used to not be an option. However, on top of all those benefits for online payment services, probably one of the biggest and most important reasons this is a good idea is because they are secure. The online payment is secure and convenient. Meaning, not only is it, yes, convenient, it's easy to do on your phone, it is secure. If you are paying your utilities bill, you're paying your phone bill, you're paying your rent, your mortgage through a bank, or however that works out, it is secure, meaning it helps protect you against fraud. So if somebody tries to steal money from you that way, there's all these checks and balances here that stop that from happening and can reimburse you if something crazy happens. Whereas paying in cash, obviously if cash disappears, it's gone. A check, if it doesn't show up in the mail, you can get hit with late fees and things like that. So online payment is not only secure, but it is very convenient and also helps prevent you from having to balance a checkbook. But the question here is, what is the benefit of using online payment services? So we got done talking about that. So pause me, answer that completely. We're moving on. All right, a couple other aspects of financial goals. In order to reach your financial goals, one of the big ones is choosing a mortgage lender to start with. Say you want to buy a house. Everybody wants to loan you money, all right? Especially if you have a down payment. People want to lend you money. If your credit score is good, we'll talk about credit score later on in another unit. But if you are a good candidate to receive a loan, everybody's going to loan you money, all right? Because you have to pay them back plus interest, they make money off of that. So you have to be very conscientious over what bank, what mortgage lender that you go with. Is the cheapest one the best one? Are they the ones that are the most secure? Are they giving you the best long-term options? Are they giving you the best rates? You have to really look at this when you're choosing a mortgage loan in order to meet your financial goals. You also have to make sure that you choose the right plan for you, whether that's a fixed rate mortgage, which is by far the most common, an AR, adjustable rate mortgage, a balloon mortgage, depending on your situation. Usually long-term goals, unless you're flipping houses, you're probably going to go with like a fixed rate mortgage is the most common one, at least present day it is. And then let's talk about insurance. Now, This is the one that's hard to wrap your brain around when you're younger, but as you get older, especially if you've ever had an instance where you really wish you had insurance or you did have insurance and were very happy that you did. All right. So insurance helps prevent catastrophes. So I'll give you a little personal story. When my daughter was born, there was a whole bunch of drama surrounding her birth that we were not expecting. She's completely fine now, but for like 40 days after she was born, she had like a 50-50 chance of survival. Miracle came out of it and was fine. However, 40 days in super intensive care unit, the bill for 40 days in the hospital was $800,000. $800,000, almost $1 million. I'm a school teacher. I don't have that, but I did have insurance. So while it cost me $5,000 to pay my deductible, that is all I had to pay, and insurance paid the rest of it. Had I not had insurance in that situation, then I would be financially ruined. I would have had to sell everything I have, start over, be in debt, never would have got out of that. Having insurance feels a lot of times you're begrudgingly paying these insurance premiums. You're like, I don't want to pay it. They keep it from ruining your entire life plan. One catastrophic issue without insurance can wipe out everything you've worked for your whole life. Health insurance is what I had. That's what you should also have. We don't have universal health care in America, so you need health insurance to make sure you don't get in a catastrophic injury and take 6 months to recover, and then to come to find out you owe millions of dollars to a hospital without insurance. Everything you've ever worked for gets wiped out at that point. Long-term disability. This is another one. If you get hurt and you can't work, long-term disability insurance will pay you as if you were still working until you get back on your feet. That's a rough thing to have to pay every month as you are healthy and working. You're like, why am I paying the premium on this? Because if you don't, and something happens where you can't work, that could wipe you out. Auto insurance, while it's required to have a liability in most states, auto insurance is really important because if you go hit, a Lamborghini and you have the most cut rate insurance possible and it's your fault, while your insurance may cover $50,000 in damage, but you hit a $500,000 car, that's on you. Whereas you could have gotten just for like a few more dollars a month, you could have had it cover up to $1 million. So these types of things you have to take into account. Life insurance is also a big part of a financial plan, especially if you're married. Now, if you're single and something happens to you and you pass away, well, if it was just your plan, that's fine. But if you have a spouse, children that rely on you and things like that, life insurance is important because if something happens to you and you unexpectedly pass away, there is a lump sum that pays out to what's called the beneficiaries, would be like your spouse and possibly your kids if something happens to you and your spouse, in which you can continue with your financial plans because it's a large lump sum. Insurance, while it is not fun to pay premiums because you're paying money for something that you have nothing in your hands, having insurance is a pivotal part of having a strong financial plan, because one catastrophe happens and you don't have insurance, and the way our society and economy is set up, everything you've worked for, if you've worked for it for 20 years, is just gone, and then you can be in catastrophic debt and your whole life can change almost overnight. So having insurance and a variety of different types of insurance is an absolute necessity in order to having a strong, functional financial plan. So the question here is, what is a benefit of having insurance in a financial plan, and how does it help with financial security? And it's because it protects against unexpected expenses and losses. If you have a house and it burns down, but you have insurance on it, they will pay you to rebuild the same house. All right. If you don't have that, all the money you've invested in that house is gone. Same thing with rental insurance and things like that, but you get touchier in there. Anyway, so answer that completely. That's what I got for you today. See you guys tomorrow.